Well, how's it going, friends and family? In this video, I'll be going over 3 different topics. Number 1, why I put in the effort of doing the Compounders Corner every single Sunday, essentially tuning into the weekly earnings. Number 2, why I love value investing. I feel like there's already 20 videos on the channel of why I do, but it's always good to have a refresher. And then number 3, we're going to be talking about my baby girl's stock portfolio. So jumping on over to topic number 1, from time to time on the channel, I'll get a comment from one of you guys. Sometimes 2, 3, 4 of you at once per upload that the Compounders Corner, it's way too long, a waste of time. Why do I bother doing it? Bottom line up front, my whole thing is by doing a little bit of legwork at the beginning of each earnings week, maybe an hour of 2, there's a lot of money to be made. Case in point, past couple weeks as an example, some heavy-hitting blue chip companies that everyone should know. First and foremost, I guess we could talk about SAP, one of my core positions featured in the public portfolio series. So to back it up a bit, SAP is a tier 2 ERP software that pretty much dominates Europe. I think they're the biggest market cap company based out of Europe. I love this one, okay? Leading up to their earnings, they were flirting with about $145 a share. So by recognizing that SAP is a high-quality dividend compounder with cheese, imagine I bought the dip leading into their earnings. What happened? What transpired? Immediately, 5 days afterwards, 25% into the green. Okay, let's do another one. IBM. About a week ago, we did a dedicated deep dive on IBM. Now, this is a different angle. Immediately after their earnings, they dropped off a rock. They were flirting with $300+ a share, and they dropped all the way to 199 bucks. But by recognizing that it's a blue chip compounder and you bought the dip, well, let's just say the past 5 days, you'd be up 8% in the green, effectively from 199 to 223. And then we'll do another one, Netflix. Another compounder that was featured on the Compounders Corner. Take a look at what happened. After they reported their earnings, they dropped from about $75 a share to $65. If you bought the dip anywhere from $65, $66, or $67 a share, and your current position is around 71, 62, obviously it's a red day, you'd still be up in the green. Happy camper for about a week's worth of holding that stock. Another one that was featured in the Compounders Corner that I talked about, Oracle. After they reported their earnings, they dropped off a cliff. You bought the dip. Again, past 5 days alone, 8% in the green. And we'll do another one, Lockheed Martin, ticker symbol LMT, my pick number 2 in the military industrial complex space. Going into the earnings, they were selling off day after day, week after week. And I think as a low, it was around $500 a share. Had you bought the dip and post earnings, your position, you'd be a happy camper. Going from $500 a share to roughly $582. And we'll do another one. Abbott, a core position in the cheese public portfolio series. Heading into their earnings, there was a lot of uncertainty surrounding this company. But if you drowned out the noise and you bought the dip, and we take a look at what has happened since, you'd be in the green, 16%. And last but not least, this past week, one of my biggest positions, Microsoft. Going into the earnings, Microsoft, it was a little rocky, flirting with like 380, 375 a share. You bought the dip, past 1 month, 24% into the green. Past 5 days, you could see immediately after reporting earnings, they went in the green 21%. So friends and family, that's exactly why I do the Compounders Corner and why I pay attention to the companies reporting their earnings every single Sunday. So I know which ones to pay attention to so that I can do the homework up front to understand when I want to jump in if there's a market overreaction and they sell off, because I don't want to just willy-nilly buy at any price, right? And don't get me wrong, it's absolutely fine to buy a stock just because you like them. Doesn't matter about the day-to-day noise or short-term fluctuations. Okay, but for me, I like to be patient. I like to buy them when the market presents me an opportunity. Now here's one I didn't jump into, but Meta. Immediately after reporting their earnings, look at what happened. They dropped off a cliff, going from effectively $681 a share down to roughly $525 a share. If you bought the dip, even with Meta, purchasing them for about $525 a share and currently $551, you'd be in the green a little bit because everyone understood that it was oversold. To drop off that deep for a mega cap Mag 7 conglomerate, right? And then topic number 2, I want to talk about how value investing is alive and well. It's a school of philosophy that I subscribe to and I practice. I live it out in reality. So what you see on your screen right now, year to date, so for the past, I guess by the time you see this video, it might be like August. So past 8 months, VU, representative of the S&P 500, 500 blue chip household names, about 10%. It's not bad, right? However, we need to give SCHD props. Credit where credit is due. We got to give them their flowers because if we pull them up right here, Charles Schwab, the US Dividend Dow Jones 100 Index, ETF, year to date, if we compare them, SCHD is the orange, 24% to that of the S&P 500, 10%. And if we add in the additional 4 months, back it up and say 1 year, then SCHD 29%, VU 19%. For all case and purposes, SCHD is the textbook definition of value investing. And value investing is defined as the strategy of buying shares of a high quality compounder when they trade for less than they are worth. And I know I'm manipulating the timeline. So if we back it up like 5 years, then you'll see that the S&P 500 is 83%, SCHD's 57%. And that's because leading up to 2025, value investing underperformed tech stocks that were just flying and ripping day after day. But 2026, the tables have turned, and now SCHD is in favor in the short term. So who knows who's going to be the winner in the next 3 to 5 years, because past performance is not indicative of the future. So circling back, why do I love value investing? Well, hear me out. There's certain satisfactions in life that are unexplainable unless you experience it yourself, such as taking a very cold shower after you go on a summer run. You go for like a 10-mile run and you're just soaked in sweat. Taking that cold shower, an amazing feeling. Or such as getting a haircut after looking ragged for weeks on end. Doesn't matter if you're ugly, overweight, short, or tall, every single male, after getting a fresh haircut, you walk out the barber shop or the salon or whoever cuts your hair, the wife cut, such as my example, you'll feel a little bit more confidence. That self-esteem goes slightly up. You can just turn that notch up. And of course, last but not least, the satisfaction in buying the dip on a high quality compounder with cheese when everyone else thinks it's trash and it's all over. And because you bought into the fear as a result, you got a discount. And by buying shares of a beautiful compounder, it gives me asymmetric upside, meaning the downside risk is not as prevalent as the upside because you bought it with a margin of safety. Because I stand firm on this hill, even a good business can be a very bad investment if you overpay for it. Such as, for example, let's say you do your analysis, your homework, your due diligence, and you determine that a stock for a particular company should be valued at $500 a share. But let's just say that you got FOMO and you bought the first dip at about $450 a share. The upside from $450 to $500 to reach their inherent worth, not the highest payoff, right? But let's say you were patient, disciplined, and you understood when to start nibbling, when to open up that initial position, and when to dollar cost average. And let's say when it's all said and done, your cost basis is $350 a share and the inherent worth is $500. That upside versus that $450 individual is better, right? And that's why between you and me, I do not practice lump sum investing, even though there's a lot of data and research and studies that proclaim that it's better. Because I've witnessed it myself, my personal experience. When you go all out, gung-ho, into a position immediately after their first dip, and you have no more gunpowder available, your heart, your stomach will toss and turn when you see that position go even further into the red. So for me, I like to do dollar cost averaging instead. And I always play it like this: 10% up front during that first initial dip where it's too good to be true. And then if they dip further, I'd throw down another 20 to 25%. And when they reach that bottom Bollinger Band based on the technical analysis, and I think it can't go any lower, that's when I back up the truck and then I load up the shares. But to go all out during that first initial dip, from my personal experience, I have regretted it every single time. And that's why I'm more patient and more disciplined the older that I get when it comes to investing in stocks. And if you're a friend of the channel, then you know I'm not making this up. And I put the curriculum into reality when it came to United Health, when it came to Huntington Ingalls, when it came to Microsoft. I never went all out during that first minus 5% dip. But rather, when they went negative 40 or negative 50%, you know that's when I loaded up. That's when I used the gunpowder, the reserves, sent in the QRF, the reinforcements, all out. Reason number 2 as to why value investing makes sense to me is by being hands-on and a little more active with my investments. I get to control when I buy and optimize the most oversold opportunities versus the other side of that spectrum, dollar cost averaging on autopilot every week or every 2 weeks. I feel like that's the more efficient way to go about the stock market, to just turn everything off right here and just let time in the market to do the heavy lifting for you. But for me, I like to calculate and be precise when I enter and when I start accumulating more shares, because the whole idea behind value investing is to try to get the best optimized lowest price possible before the inevitable rebound. Because if the company in question is truly a robust compounder with an economic moat that's as wide as your wife's waist, and their future trajectory looks really good, but it's short-term market noise or a hit piece or somebody on Twitter said something and that caused them to sell off, and as a result, I get to buy a company that I wanted to at a 23% off discount, dude, sign me up. And that's why I love value investing. When it's done right, you beat the market. And I've been beating the market for the past 7 years. But sometimes when it comes to value investing, it's also playing with fire. Because by applying the principles of value investing to a cigar butt or a disgusting, hideous company, and you start to turn a blind eye to the red flags and stuff that is questionable, and you start dollar cost averaging into a company that has a declining EPS year over year, negative free cash flow, a dividend profile with a payout ratio above 150%, and they cut their dividend in the past 5 years, and you start justifying why it's okay, to me, I don't think that's value investing. I think that's borderline gambling because you're waiting for a turnaround play, a rebound rally, or some speculation or narrative to help drive the business forward. Because value investing, the whole premise and the thesis is to buy a high quality, best in class, either number 1 or number 2 in their landscape. Like, why go for number 17? Why go for number 18 in that sector or industry? They can't be best in class. They cannot be high quality. There's only 1, maybe 2, I guess, in the envelope of tech and semiconductors and AI, I guess there's more than 1 or 2. But for the most part, across every industry or sector, there's clearly the S-tier compounders, maybe 1 or 2 companies, a few in the A-tier, but to entertain or dabble with the companies that are graded as a D or an F, I don't think that's value investing. At this point, I'm at a political rally and I'm just preaching to the choir. Everyone is shouting, yeah. I don't even know why I went on such a soapbox and gave a speech like that. But anyways, pivoting to topic number 3, my baby girl's Trump account was finally funded with $1,000. The 530 Alpha, where every American baby born gets $1,000 to get them started early as dividend growth investors. But that made me think about it. I just became a first-time dad about 9 months ago, and it's kind of crazy because in most parts and regions of the world, anybody under the age of 18, let alone the age of 2, they are not invested in stocks. But for most babies here in the US, born in 2025, 2026, They can legitimately say they're invested in equity, where they have $1,000 of capital towards some of the biggest heavy hitting names. Speaking of which, by default, every Trump account, the $1,000, it gets deposited into SPY, which is another S&P 500 ETF, kind of like VU, except this one has a lot more volume and assets under management. And going forward, I think that's going to be really fun. I'm going to do a friendly competition between my baby girl's SPY position in her Trump account versus the public portfolio that's on the YouTube channel. Obviously, because the dollar amounts don't align, we'll be grading the performance based on CAGR, the compound annual growth rate, so the percentage change year over year. So SPY, historically, it's at around 12.5%. And between you and me, it's going to be the ultimate battle between individual stock picking in high quality compounders versus the S&P 500. You have my word. If my baby girl's portfolio starts beating me quarter after quarter, year after year, I'm just going to join her in that strategy. Just go to a simple passive investing philosophy, S&P 500, call it a day. But I have a good feeling, since I've been doing it for 7 years, that I will beat the S&P 500. But anyways, taking a look at her position as SPY, let's just see the top 10 companies that she's invested in. So, blue chip household compounder, we have Apple, Nvidia, Microsoft, Amazon, Google, Broadcom, Meta, Micron, JP Morgan Chase, Berkshire Hathaway. To be honest with you, I love it. I love that my baby girls invest into such high quality names. There's none, at least in the top 30, that I can disagree with. Every single one of these, pretty good, at least for the short term. Obviously, the landscape and business and operations can change 15 years down the road, but the S&P 500, along with most other indexes, they change. It's fluid. They rebalance periodically. They kick members out and introduce new ones. But as it stands, it's pretty good. However, having said that, right now, every single Trump account, it's managed by Robinhood, and every single Trump account has to go into SPY. However, apparently, once the Trump accounts become more mainstream and more resources and funding occur, the ability and flexibility to switch brokerages or positions will be on the table. Once I can change the position of what baby girl is invested into, I'm going to change the position. So right now, SPY, 1 year out, 19%, it's pretty good. But what I'm thinking is the Vanguard's IT ETF, known as VGT. And the other one that I'm considering is the VanEck Semiconductor ETF, and that's ticker symbol SMH. Shake my head. I would rather see her capital be deployed into these two ETFs than SPY, let alone the QQQ, because if we do, I don't know, the past 5 years, so the blue line is SPY, total return is 82%, and that's pretty good. For most individuals, if you break that down on an annualized basis for the past 5 years, the CAGR is 12.8%, and that's respectable. But for VGT, it's 17.8%, and for SMH, it is 33.6%. And so when you take a look at the total return of 5 years, purple SMH is 300%, VGT is 120%. If we do 10 years, so you can see why my thought process is to put her into ETFs that skew heavy towards tech. Because I think for someone that's less than a year old, that type of aggressive weighting is absolutely fine. And I think for the next 10 to 20 years, at least until she becomes an adult, I truly think VGT and SMH will outperform SPY. Having said that, I think SPY as a default option, I could agree with. I think for most ordinary Americans that do not care to become involved with investing or become hands-on with picking individual stocks and whatnot, S&P 500, I think, is the champion, the best index fund to be invested in. I think a case can be made for SCHD, but I think for the ordinary American, I don't think they need a value investing, a dividend-focused ETF. I think S&P 500 and call it a day. What do you guys think? If you were under the age of 1, which ETF would you rather be invested in? Obviously, I'm only one guy. I'm a human. I make mistakes. I'm personally leaning towards VGT, because I feel like with SMH, it is very cyclical. And right now, Obviously, we're having the AI infrastructure boom of chips going through the roof. But who is to say that's always going to be the case? Whereas with VGT, it's basically the QQQ, except I prefer the weighting of the top 15 more. QQQ is also good as well. Anyways, I love you guys. Hope you enjoyed this video. I'll talk to you next time. Stay safe. Good luck in the stock market and have a good day.